Hello, I'm Kevin McCaffrey, and I thank you for joining us for the Private Markets Insider webinar. I'm sharing the agenda on the screen here, and I'd like to kick off with a few quick program notes. We have a fascinating program today with 2 panels and 2 brief presentations featuring 5 insiders discussing opportunities in the lower middle market to kick off. Followed by a panel, Secondaries and Sustainable Portfolios, then a brief presentation on consumers and creative deal structures, followed by an addition to the panel, essentially calling panel number 2, New Opportunities in Turbulent Times. And also, please note that the following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, I encourage you to use the Q&A feature. We'll answer as many questions as we can during this webinar, and we will follow up afterward to answer any remaining questions and to have conversations where appropriate. These and more details, including speaker biographies, are available on our website at privatemarketsinsider.com. And now I'll take down this agenda and get into it. Okay. Hello, everyone. I'm Kevin McCaffrey with Private Markets Insider, and I thank you for joining our webinar. Let's address the elephant in the room, okay, to start. Global news is grim. Volatility is high. Consumer and investor sentiments are low. Maybe we're all screwed, but we can't live our lives thinking like that as people, and we can't operate without some sort of optimism as investors. So I'll be asking our insiders to share their thoughts around what has them excited. And now that there's less confidence in the free money, growth of everything, throw a dart at the board approach, how are investors finding opportunities and looking beyond the mounting challenges? Let's talk about the long-term portfolio construction, tap in new strategies, and using creative structures that help to find a way forward while watching your backside. And with that, I'd like to introduce Brett Hickey, founder and managing partner at Star Mountain Capital. He'll be sharing his screen with a few slides in a moment. Brett Hickey has been structuring, analyzing, and managing private equity, mezzanine, and U.S. government-sponsored investment funds for over a decade. Prior to launching Star Mountain Capital, Brett was the co-founder and president of a multi-manager platform, including 4 U.S. state-sponsored small business investment funds. Mr. Hickey has extensive experience performing due diligence on, selecting, and building small business fund managers, and has helped structure over a dozen larger funds representing a few $1 billion in assets. He formerly worked as an investment banker at Citigroup, formerly known as Solomon Smith Barney, where he worked on over $8 billion in completed debt and equity capital raising and restructuring transactions for leading financial institutions, including BlackRock, Franklin Templeton, Neuberger Berman, Newman Investments, and Eaton Vance. He graduated with distinction from McGill University in Montreal, and Mr. Hickey is a former Canadian national gold medalist and North American medalist in speed skating. So we're excited to hear what he can share with us today on opportunities in the lower middle market. And please, Brett, take it away.
Thank you, everybody. Nice to see some new and old faces on our panel together here. And I'll first start off with just a quick overview of Star Mountain Capital and as Kevin mentioned, some opportunities in the lower middle market. As Kevin mentioned, I started my financial career at Solomon Smith Barney, covering asset managers, banks, and insurance companies, and was fortunate to gain a pretty broad perspective. I actually started my first career prior to that in the late 90s, as many did, had the tech bug, and I ended up learning to code, and I built and sold a work placement agency in the healthcare industry. I wish it was more financially relevant than it was for the exit, but it was a lot of fun. And when I moved to New York to work at Solomon Smith Barney, that gave a really interesting global perspective. And the lower middle market for me kind of married those two things together. So for the last 19 years, I guess that is now, I've been investing exclusively in the US lower middle market alternative space. The reason I started Star Mountain Capital 13 years ago was to bring large market capabilities into the lower middle market. Love the lower middle market. The inefficiencies are great, but when you're running your own tiny little deal chop shop, it's hard because you have your own inefficiencies. So at Star Mountain Capital, I opened up our first office in India over 12 years ago. We have 14 full-time people there. We've built a bunch of custom technology. And ultimately, what is interesting about the lower middle market, and I think it dovetails well in what Kevin mentioned earlier around where are there opportunities and how do we think about today's economy. For those that know me well, they would know that I've been a bit bearish on the economy for about 6 years. So don't ask me to try to bet on public stocks for you because I'm sure I would be horrible at it. I don't even try with my own personal capital and certainly wouldn't with other people's money. What I like about the lower middle market is that you can be a value investor, which I think is important in today's type of economic environment. And you can also potentially more systematically get asymmetric returns. What do I mean by that? If you're doing lending or private equity, if you take lending, you can lend generally with much lower leverage ratios, better covenants, and so forth, and perhaps get equity upside for that asymmetric potential reward through warrants, preferred equity, and similar instruments. So potentially you can protect your capital better. And if those companies really do grow and do well, which of course middle market companies generally come from the lower middle market, and it's much easier, as we all know, to double the size of a smaller company compared to larger. And I think, as everybody also well knows, there is a valuation arbitrage where the middle market is more highly valued than the lower middle market. So if you can just simply grow your company a little bit bigger, you get a higher valuation. So that allows you to then capture some of that asymmetry and potential return if you're good at it. The challenge, of course, and as I think we all know in life, nothing's free. The challenge is that it's very hard to find these deals. It's very time consuming to properly underwrite them. I put an emphasis on the word properly because most of these businesses don't have highly detailed, KPIs, dashboards, and so forth. They might be great businesses, but you have to be able to peel back the onion and dissect it to figure that out, right? Kind of the old adage of a diamond in the rough type of thing. And then from an ongoing management, they're not going to have the depth of management, the depth of resources that a big company would have. And so what we believe is that to properly manage, you need a more labor intensive way of doing it. And that's why we like to try to generate, upside even from the lending business at Star Mountain, because we want to try to get paid for that labor. So that talks a little bit about the lower middle market. How we've addressed that is with people local in 20 cities across the country. We have now 100 people, 60 full-time, and over 40 operating partners that are 100% aligned through carried interest and exclusively focused on this end of the market to try to tackle both the challenges and the opportunities of the lower middle market. There was a question earlier, how do you define the lower middle market? This is a way that I think most people think of it in general. When terminology lower middle market came about, maybe 20 years ago, roughly, I think it was meant to say that it's not a startup, right? It's not the venture capital world, but it's not what people called core middle market. So it's not a business that generally your big branded asset managers are going to find of interest. Generally speaking, those are usually companies with between about 5 and 30 million of EBITDA. It's a bit of a world of grays, right? It's not just explicitly black and white. There's lots of different dynamics that ultimately do create either efficiencies or inefficiencies. But that's a little bit about how we think about the market, and I think many do as well. What's interesting about the lower middle market is it represents approximately 50% of US GDP. And with an aging demographic, you have a lot of business owners interested in doing something, and that creates a lot of opportunities for people that are lenders, people that are minority growth equity investors, people that are controlled buyout investors. You need businesses that are willing and desirous of transacting. And if you can grow to become that middle market company, there's so much capital available there that basic laws of supply demand exist, and that drives up valuations, brings down cost of debt, and of course is a very enviable thing for a middle market company, for a lower middle market company to become a middle market business. That's really it. I guess from a team dynamic perspective, the way that Star Mountain approaches this business is both from a credit, private equity, investment banking. We don't offer investment banking services for sake of clarity, but the internal capabilities are both private equity, private credit, as well as investment banking and operating partners, where we have full-time people that have ran lower middle market businesses. And we think that's important to addressing the reality, because on paper, it all looks great. Great, I can do a low levered loan with higher rates. I can get some upside. That seems fantastic. But if there's challenges, you need to be able to manage them. And if you want to be a partner of choice to business owners versus an investor of last resort, you generally want to bring a value proposition to these businesses, at least in our opinion. I won't mention much more around this. We might get into it today or might not, but I think culture is perhaps more important in the lower middle market than in other markets, because you're dealing with business owners that are often very ingrained in their community and so forth. And I think that's where one needs to take more of a blue collar-ish approach, if you will, a localized approach, not just a Wall Street trading paper type of approach. I'll stop sharing there and pass back to Kevin.
Oh, well, thank you for that, Brett. And while you're speaking of culture, and as I bring on the other speakers for a panel discussion, to create some context and help people understand who you are, I'm going to be asking everyone to introduce something personal and something professional that has you excited in today's gloomy world that I portrayed.
Do you want me to go, Kevin, or you want before
if you could, Brett, just share something personal and something professional that you're excited about.
I'll be the guinea pig. I guess on I think earlier on you said what's something that we're sort of looking forward to. I guess something I'm grateful for. I recently had my third child, another daughter, and I'm thankful for that. I'm looking forward to and hoping the trends continue, where last night she slept a full 5-hour segment. I'm looking forward to that, hopefully extending as I look into the future. Thanks.
Well, that makes a lot of sense. And to apply the expertise that you're talking about, you need some sleep, you need a clear head. And with that, I guess in no particular order, but I'm going to ask Eric Newman to start in terms of, please just, if you can introduce yourself in terms of your firm, your role, yourself, and as I mentioned, with the gloom that's been hanging over us the last couple of years and the news cycles and uncertainty, share something personal and professional that you're excited about. Eric?
Sure. Hello, everyone. I'm Eric Newman. I'm a treasury manager with the city of Stamford in Connecticut. We're the 7th largest city in New England. Our pension funds have 1.1 billion of AUM over 5 different plans. I serve as a trustee on several of our pension plans. They also serve as a trustee on the town of Fairfield, Connecticut's pension plan. Over there, we have 640 million of AUM across different allocations. Something professional, I just got back from a USAID MEDA delegation trip to Africa. We went to Dakar, Senegal, then Nairobi, Kenya, to meet with private equity funds over there, African pension plans, government officials, to figure out ways to mobilize more investment from U.S. investors into the continent. They have many different countries, and one thing I've learned is that in the U.S. pension plan system, we have $35 trillion with a T of assets under management, yet we invest under 1% into the continent. Something personal I'm excited about, I have 2 kids in college. They'll be finishing up and returning home, and it was great to have them, much better, smoother year this year than in the previous years with all the lockdown. So excited about that.
Right. Well, I'm sure we're all glad to be back in action, and glad to see you're taking advantage and getting out on the road. we should have a separate discussion around your U.S. aid delegation. But with that, I'll ask Sasha Bernier, if you can introduce yourself, firm, role, and is something you're excited about personally and professionally.
Yeah, sure. Thank you, Kevin. So I've been at Cheltenham Enterprises for over 10 years. It's a family office where the primary focus has been in real estate. But I think what I've been most excited about is that I recently formed an entity that's focused on building what I think is what I call the future. So future meaning technologies that I think are disrupting old businesses called Hestia Holdings. Something I'm excited about is, as you know, I just got back from traveling some places in Southeast Asia. I started several schools out there, and I have a partner out there. We're excited to be building and growing in a region that we're very excited about. So thanks for having me.
Okay, well, I'm glad I asked. A lot to dig into when we finally circle back. With that, Calvin Marks, please, if you can introduce yourself.
Sure. I'm Calvin Marks. I'm a, a director at Felicitas Global Partners. We're an asset manager in California with an AUM of 650 million. We have two lines of business. One is a fund of funds where we allocate to managers across private equity, credit, real estate, venture growth, as well as a small secondaries fund. Right now, what's got me excited, I'm soon to be the parent of a small Bichon poodle. Been on the wait list for quite a long time, so that's going to be great. And yeah, I guess professionally, we have a lot of what I consider really exciting deals that we're going to be closing soon and looking for co-investors on. So I think it's a good time.
Excellent, thank you. And just circling back to everything that Brett just provided for us as context, why don't we start perhaps with Eric again, just going back to the top. Why would you say that you do or do not agree with Brett's assessment of opportunities in the lower middle market? Is that a place where you've been active?
We've been exploring it. We don't have currently any investments in lower middle markets. You know, our pension plans, our municipal pension plans, and it's spread over 5 different plans. So sometimes it takes time to go into new allocations. We've been in private credit and different funds. There's definitely opportunity when, especially, you have better covenants, you have better returns, you have more upside potentially as a smaller company expands. They need the growth capital, and funding at the lower level creates jobs and gives opportunity. And as it goes to the next level, there's more opportunity for lending. We all know that as if you're the top tier, you know, everybody's willing to lend you money. If you're at the more of a, you know, smaller organization, getting that capital is always tough, and it creates more opportunity. And it is definitely inefficiencies, which creates that opportunity to get the higher yield.
Right. Well, it seems like you're in agreement with all the talking points, but I understand since you're managing a lot of your capital through consultants and so on, you know, this is why I think it's important to talk about the lower middle market. People need to understand that the water's fine, jump right in, and there are a lot of compelling reasons. And Sasha, I'm curious, you know, given your take around real estate, which may not be related, but certainly, you know, building the future and some of the tech, what are your feelings about the lower middle market?
No, I think I agree a lot with what with what Brett and Eric have said. Right now, it's all about like, where can capital flows go into where there's not competition, right? Because wherever the money goes, inefficiencies decrease, and it begins to get harder to outperform. And that's why you see, you know, like the public markets, high stage VC, all these things are just really hard to put your hands around because there's just so much money going into those sectors. But even if you were to look at the lower middle market, I think it's becoming super competitive also. Like there's just so much money out there, right? And so I think that you know, if you can find an edge where it's not just about having as much money as possible, then you can actually have real value add. You have to go where the big money isn't willing to go to, where things can't scale, or where it's not about scaling a fund or trying to put as much as money as possible out there, as opposed to trying to find areas where you actually have to do real value added, right? And so I think right now, the lower middle market is probably where you can have the most value or add the most value, because someone like Blackstone isn't going to go into the lower middle market because it makes no sense for them, right? So I think that in this market, the hairier, the better.
Well, I would certainly agree. Hit them where they ain't, I think, is the old quote, and that I think highlights what Brett was saying about just the opportunities for growing these smaller companies, as well as that multiple arbitrage. And it also dovetails with arguments a lot of you in the audience have heard me make in the past around the value of private markets versus public markets. There's room for arbitrage. There are places where people are doing work where, unless you're an insider in the business, you can't pay close enough attention. So pardon if I'm a cheerleader in some of these cases, to an annoying degree, but that's where this discussion seems to take us. And Calvin, what are your thoughts around the lower middle market?
I think it's a very complicated area, and you need a lot of expertise to be able to do it correctly. As Brett was saying, we've dabbled in a few deals here and there, but we're much more of a growth investor, and we do on the buyout side a bit more in the mid market. So I think to do it correctly, you need to really understand the core businesses. They're very hard to value. There's not a lot of comps in the area. So if you want to invest money with a group like Star Mountain that has that expertise, it makes total sense to do so. Okay.
Well, that was those were almost fighting words until you gave that wonderful compliment at the end. I thought we were going to have a debate on our hands. But I think you raise a really good point around expertise, and I'd like to dig into that later, because I do think that sector expertise and specific segment expertise within areas of the market, whether it's in the assets or what have you, are crucial, and that's where insider expertise comes in. Do you find safety? I'll start with you here, Calvin, in larger deals versus the lower mid market, where perhaps debt to EBITDA ratios are typically a little lower. Why have you focused more on larger deals?
Yeah, it's a good question. I don't think we necessarily focus on larger deals. I think they're very prevalent right now. You see the term GP-led everywhere. A lot of larger managers are doing very big deals. And for LPs and secondary funds, it could be a bit of a no-brainer because they're allocating with brand name managers and their name is at risk and they're rolling carry. So it may be an easier play for them to allocate to those deals. We tend to shy away from it just based on the amount of leverage in the system. If you're buying a company that's mature, that's valued at 20, 22 times EBITDA, you're going to probably have to use 7, 8, 9 turns of leverage to really make that return meaningful. So we're really looking for, as Brett said, more value-based opportunities, companies that are still mature, but more, modest upper single-digit type ratios in terms of EBITDA and leverage. We're obviously looking for sub, 3.5, 4 times. So I think, that there's no right answer to that. It's just whatever you have the most, confidence in towards providing good returns for your investors.
Yes, I agree. And turning to you, Brett, since, we're sitting here talking behind your back, why don't you tell us why you have focused so heavily on the lower middle market and how you feel about those lower debt ratios and some things that I know have been a highlight of your strategy. And feel free to comment on anything that you heard around the other comments from our group.
Sure. It's I'll make it a little bit personal because I know, Kevin, you like to keep things interesting, and I look forward to the pre and hopefully post COVID days where we can get some of those events together again that you did a great job with. But I sort of come into the world of finance with ignorance. And if you've ever listened to any of Ray Dalio's content talking really about why you do things and what the focus is, it's in a totally different market segment than we do, right? He's, I think, almost all public markets. But the concept in how we built Star Mountain and why is, where are there opportunities, right? If you just take a step back and you say, what are the dynamics that create an ideal market, right? You want a growing market. Well, the lower middle market companies, at least in the data over the last 5 years, grow revenue faster and less volatile than big companies. So that's a nice start. It's nice to have companies that grow faster in a less volatile manner. It's easier to be right if right trends are on your side. Second, as Sasha mentioned, when you think about supply demand, as Eric can attest, in different parts of Connecticut, houses, I live in Greenwich, a house here and a house in other parts of Connecticut, same house, worth very different prices. People seem to somehow forget about basic laws of supply demand. It's very straightforward. So if there's assets that are easy to access, where everybody can jump into them, of course, valuations will be higher, diligence will be more limited, covenants and credit will be more limited. It's just all basic fundamentals. If you look at, and I typed this into response to one of the people in the Q&A chat here, but Moody's and S&P both have nearly 25-year reports, actually very straightforward over lots of cycles. Risk is a multivariable equation, but what they've found systematically is that higher leverage gets you in trouble. Whether you're a big company or a small one, the data from a probability perspective, right? That doesn't mean you can just say a low levered loan is automatically safe or a high levered loan is automatically unsafe, right? Some companies are deserving to different levels of leverage and so forth. But I like to have trends on our side. What I don't like as an investing strategy, and this is just me personally, is thinking I'm smarter than everybody else. So I want data, I want fundamentals, I want facts, I want probability weighted analysis. I don't want what I used to do early in my career. I spent a year, as you know, Kevin, working on the oil drilling rigs in Northern Canada. I've worked on service rigs, I've worked on deep drilling rigs and so forth, and growing up in that environment, I have a lot of relationships. When I initially launched my first fund in 2004, managing money for the Texas Treasury, we had to invest in Texas-based companies, underserved areas, and as you can probably guess, we invested in oil and gas businesses. As I think luck would have it, I did well. However, when I take a data-driven approach, I say that incremental volatility you get in the energy cycle, we don't get well compensated for in the lower middle market. So since founding Star Mountain 13 years ago, we've never invested in a single oil and gas business that way directly. And so I guess if you look at data, I'm always a big fan of that. I'm not here to say I can guess what's going to happen any better than anyone else on this panel or any of the participants, quite frankly. But I want probability to be on our side. And in the lower middle market, you have a supply demand benefit. Again, you need to be able to, as Calvin said, do it the right way. And that's why I built Star Mountain this way, because it's tough, right? You really need to peel back the onion. On average, a smaller company has a lower quality, or at least not say quality, a lower depth of management team, right? That's a probability driven fact. So you need to be able to assess that, assess key man risk, and you can't just look at the financial statements to get those answers. So again, as Sasha mentioned, why does it not make sense for somebody big to come down market? It's too time consuming. But for me, I guess from oil rigs to speed skating to what I do now, I'd rather get paid for labor than trying to view that I'm smarter than other people or guess the markets. So that's really it. And for those of us that know us, obviously, I shouldn't say obviously, but it happened, so it played out quite well for us.
Well, you've laid out a humble yet unassailable approach there. And I appreciate your focus on data, where I think I've heard many people claim that the problem is that they can't find any data on these smaller companies. And so they feel more comfortable with the larger companies. And, there's an element of risk around a smaller company that is perceived, but I know you've had some data showing that actually those groups feel the pain more, maybe more deeply invested, especially if it's a family business, what have you, and rolling something forward. So yeah, there are a lot of things to dig into there, but I agree. And I'm curious if Sasha agrees, and you tapped into a real estate comparison there. So Sasha, I know that you're not 100% focused on these areas, but I'm curious to hear from both you and Eric how you view this as a little bit of an outsider. You're not necessarily digging into these elements all the time, but do you perceive more value in lower mid-market or more safety, and is it worth it to be in the larger end of the market?
I think again, Kevin, again, it just depends, right? It really depends what you're paying for. And I think what happened has in the past, call it since really 2009, right? Like we've lived in this environment where it's been very hard to get people throw the word valuations, but everything is really done based on where Treasury is traded, right? And so I think we hit 3% finally for the first time since 2018. But think about when you were going to business school, right? The risk-free rate was always 5%, right? That was always like the marker, and we haven't been in 5% for for God knows how long, right? And so let's think of it this way, right? So think about if you were to do the standard right now loan on an asset, right? So if someone says to you, oh, wow, I can get 8-9%, you're like, oh, that's great, right? That's amazing, right? But with inflation at like 8%, right? Is that really, when you're taking that much risk on something that's hairier, right? Does that premium now really make sense, right? If you're doing something that's junk bonds or high yield, right? And you're only making 13%, inflation is 8%. Again, does it make sense, right? And all of this is because we've lived in an environment where everything has just been so inflated. And it's really hard, again, to put your arms around it. And so we've done a lot in with the vehicle that I was talking to you about. When we've looked at a lot of growth, the valuations went higher, and like there's like a reset. But again, it's been difficult because that's why you're seeing like these massive corrections down, because you obviously have a higher discount rate now, right? And so for the first time, people are saying, okay, let's just not just rely on growth. When you're going on one end of the spectrum, when you're talking about like VC, right? And so I think that like if you can go into opportunities that are even if, and I think it applies not just to lower middle market, right? Like, let's just say you were looking at something in venture capital, right? Really thinking about, okay, what am I investing in, right? Does it make sense? What's the market? And how do I look at it really now that I understand where rates are, right? Because as you can see, and if you think about it, in 2020, right before COVID, the Fed was beginning to increase rates, and everything just started going haywire and crazy, right? And then COVID happened, and then we stopped, and then it happens again. So it's crazy because people know what happens when rates go up, but people just fail to really put their arms around it and think about that in the context of when they're investing, right? And so I think that we're at least going through a normalization process, which we probably should have done a long time ago. And none of us really know what the effects are going to be in the future. So I think that those are things that people need to think about. And then in addition to that, I think that looking at be willing to be opportunistic and like do like niche strategies where if it doesn't have to be correlated to the market, as you go through this cycle, those are things to think about. So like, for instance, there is a group that we've partnered with where they're providing insurance on artwork that is being bidded at, for instance, at Sotheby's, right? And when we looked at that, we saw that like even like back in like '08, prices stayed steady, and she's providing insurance. If it doesn't work, you get the premium. So that's just not related to the market. And so I think you just have to be willing to step outside the box and look at things and think about the environment. And when you're investing, how the environment reflects that investment.
Yeah, one thing I would add, you think about the lower middle market. These are entrepreneurs, and they have sweat equity. They view things very differently than a more established company's management. They have this drive, this inner drive to achieve what they want to do, grow their business, get to that next level, and also brings diversity to the portfolio by having allocation into the lower middle market. You got to have on different cycles. Things could go tight. Lending can tighten up, but these individuals are running these smaller businesses know that they need to make that payment every month or quarterly, how it's structured, because they know they have those covenants, and they probably have personal guarantees, and that's the other thing I want to do is trip up and have a home taken away or other situations. So they're going to definitely work harder to make sure that they achieve what work with their lenders. If they get into that financial difficulty, they don't have probably as much leeway because they're much smaller. They can't tap the different markets, different other lenders, especially as the market might be and the economy might be going down. Another thing is, the managers, the people who are starting these businesses are going to be more diverse. And when, as a pension plan, you're always talking about ESG and diversity on boards. No better way to get you provide capital to the fund managers that are focused in this area, and they're lending out to people who might be new to our country, people who they're looking to start a business and create some wealth for their family and in their community. So I think that's another opportunity that creates incentive to look at the lower middle market.
Eric, a couple things that are helpful to add on to that. It's interesting when the conversation around diversity and what diversity means, and you mentioned people from other countries. I grew up in a town of sub 10,000 people where it was very standard to go work on mines and oil rigs and stuff, just like I did. That was quite typical, or go be a farmer. And the differences in life, and I saw it growing up, and how many of my cohort didn't graduate high school, never mind go to college, didn't make it through. Some of them didn't make it through middle school. Many did not make it through high school. I'm curious, it's the stat, I'm going to try to get it, but how many went to college and how many graduated college, but pretty low numbers. When we have our diversity stats and whatnot, it's interesting, and this is pre-Russia-Ukraine war, but I said to somebody, so how do you think about this guy that works for us that's born and raised in Ukraine as a second world country as far as how it's classified? Giving people like that opportunities, is that diverse? What about somebody that grew up in some cornfield in Nebraska? Is that diverse, right? But nobody, I shouldn't say nobody, but that's not topical. So I'm happy you brought that up, because I think there's a lot of underserved areas. And in fact, for some US government money we run, they really want to see, are you investing in low and moderate income areas in the country? Are you helping find high quality employees, business owners, giving them a chance, educating them, giving them more than just money? Another thing, when you talk about talent, and I think this is a big part of life, and I've never found a business owner or investor ever that says talent isn't a critical factor in the success, because markets will for sure change. Having people that are focused, aligned with the right expertise is a critical ingredient to success. Everybody here, I'm sure, has seen the massive, whether you call it the war on talent or the people less focused, people that are leaving their jobs, right? There's been more attrition lately than ever. Well, that's not good, right? And that happens more at big companies than small companies, because in small companies, if you align interests and if you have the right culture, and just because you're small doesn't mean you do that, but it's easier to do that, right? It's easier to have a 100-person team and have a really energetic culture and really be passionate and align interests with people than it is for 10,000 employees. That's just sort of a reality. So if you think that backing companies that have very focused talent talent that's going to be persistent and stick with you through challenges, because challenges aren't fun. That tends to be when talent leaves, unless everything's going great. I think there's a lot of data that actually is in favor of the lower middle market. As a data point, I sit on the global board of Harvard's alumni entrepreneurs, and I remember 15 years ago or so at different colleges, the finance departments, the finance clubs were the most, were the biggest clubs and most interested at school. People wanted to go work in private equity and hedge funds and stuff like that. Now people want to say, what am I doing? I want to make a difference in life. And it's the entrepreneurship clubs, and ESG is part of that, Eric, as you talk about, and the purposeful aspect of life. Those are far larger today than the finance clubs. And so once again, if you want to follow where talent is interested, which I do with my money, that's where the data is, that's where the facts are. And that's actually quite straightforward. There's lots of data in and around supporting your hypothesis, just to add to that a little bit.
Yeah, thank you for that, Brett. And Eric, well, first of all, Brett, I know you've referred to the lower mid-market as the growth engine of America, and certainly providing that pipeline for companies to grow, help people at all levels to just find a path towards building those businesses and scaling and that type of thing. And, private equity has been particularly strong in providing that pipeline over the years. And Eric, you're more involved in a very direct way, for instance, with your being part of the delegation for the US and Africa and so on and so forth. But as you talk about diversity, and I come back to center a little bit before we run out of time, how does diversity play into your portfolio's construction? And I'm curious, since you rely on consultants and have these different buckets, these different pension plans that you're managing, what drives the consultants to do the work on something that might come into your portfolio and provide the diversity that you referred to in that respect?
I guess it begins at the board level. We have to have a discussion and make it known that as a board that we want to move in this direction. One board, we had proxy voting to our investment policy. And we worked with our consultant, and to get the wording, we looked at, larger state plans, larger city plans, how they have their wording of their policy. Are we going to make a big difference on a big Fidelity or a Vanguard fund? No. But it sets a tone. It sets a tone when somebody comes around looking at our plans, and they see that, they know that this is a priority. Other plans do not have that, and I think it goes back to saying that tone. And we U.S. pension plans have a lot of assets under management, and we have influence collectively, and it might be starts off with every journey starts off with one step, and And even when we were discussing this, we had board members who were resistant. He's like, why do we need this, blah, blah, blah. And he even pointed out, well, we're not going to have any influence on the voting of a big mutual fund. But at the end, everybody agreed this is the way to go, to be a leader and be a leader and make it happen. So. And yeah, diversity has many ranges. Going back to somebody who didn't go to college, everybody goes in your circles, went to college, and then somebody new, everybody has different roles, different paths in their lives. Some people might have been new to this country, other people have been here a long time and just didn't have those opportunities. And if you might be, live always in a city, or you might have been rural. So. But everywhere you go, there is that entrepreneur spirit of Americans and globally, of people who want to improve themselves and gain that financing is challenging. And the services that the Brett's firm and other firms provide to give needed capital to these entrepreneurs is critical to the economies.
Well, it's helpful and encouraging to know that those factors come into the conversation, and that it is a considered process among the board members and so on. I also know from my experience more on the fundraising side of things that some fund managers can get frustrated with that process because it seems to move slowly. And sometimes that's just the proper process for slow turning wheels of justice and so on and so forth. Sasha, I'd like to turn to you because you're in a completely different scenario with a family office that doesn't have to deal with board discussions and challenging processes. And frankly, in that case, I've heard funds get frustrated because, also you don't have to put money to work. You can do whatever you want. So with, private markets seeming to lag public markets and, recent corrections affecting all types of opportunities. And I want to bring secondaries into this in particular as we come to the close of the panel. How are you evaluating opportunities and how are you deciding what gets on the docket, whether it's lower mid-market opportunities in general, secondaries in particular? How do you manage that process?
I think, Kevin, you hit a lot of points there. So part of the reason why I formed and this entity, as I told you, called Hestia Holdings, was because having been part of the family office, and I still sit on their investment team, it was more frustrating because I couldn't get the family to change the way they view certain things. For instance, Bitcoin, right? I'm probably throwing a huge ball curve here, but they believe Bitcoin was a scam, and up to this day, they believe it's a scam, right? And for the past, the interesting thing is for me during COVID, it kind of reset a lot of how I started thinking about things. And if anyone knew me in the past, I think you, Eric, you probably knew. We've interacted a lot. I spent a lot of time going to family office conferences, trying to find the typical check boxes of things that we would look for. If it didn't fit, like you said, there was just no question, right? And I think that sometimes working for a family office can be difficult because if they made wealth in a certain way, they're used to that wealth continue being made in a certain way, right? And most of the time, it's really just preservation of capital. So someone like Brett is perfect for a lot of families that just want to preserve capital. However,
seems like I owe some people some donuts here after this, by the way. Sorry, Sasha. Thanks.
However, for people, for what I saw in the past couple of years is, and we kind of touched upon it, I do think that technology is changing things quickly, and that the younger generations are really fed up with a lot of things that have been done historically and institutionally. And when they think about the future with like their Social Security, for instance, the government deficit, all those things. And that was really what has led to going into crypto, to blockchain, right? Was this feeling that we need to empower ourselves because we lost, this belief that, as you were talking about, like the future is bleak and we need to take control. And I do think that what I do like about the next generation is really cooperative. Like, you might have heard of the term called DAOs and all those things, where there really is a sense of doing things together as a community. And I spent like the past couple of years just really refocusing and learning about how the new generations are doing things. And came up with this concept of like longing the future, essentially, and really trying to understand those technologies. And I think that, a lot of what we've done has been clouded again by what I was talking about in terms of like valuations, right? Like you're going to begin to see a reset of the crazy numbers that we've seen, because you have like all these major companies just putting money. Now I'll give you an example. I saw someone here write down that they were at the Milken conference, and I am too. And I was at a happy hour. And it was a well-known credit fund. I won't say it, a really well-known credit fund, massive, right? Massive credit fund that's been around for ages. And they told me they were doing VC. I was floored. I was like, are you kidding me? So they're like, yeah, we're doing venture capital, because again, like they just have like so much money, right? So I say that though, because I do think that like we need to, as investors, need to understand that things are being disrupted, things are being changed. And those are really the lens that I'm looking at things. If we can find things or people or things that are resolving issues that we clearly have now, which is really what DeFi was, right? Like banks in past few years, you were making no money on your cash in the bank, but the bank was making a lot of money. So DeFi was a way to resolve that issue, right? Or you might have a logistics business, right? And it's really hard to track your goods. Well, again, that's where blockchain can come into. The concept of the DAO, right? Like there's a lot of inefficiencies when running a company. Well, okay, well, that's where smart contracts come in, right? The smart contract helps you. So I think that like for me now, like I've really, I don't want to say pivoted, because sort of like what Brett's doing, it's difficult to, it's more work value added when you're looking at lower middle income companies. But when we're looking at like things in technology, primarily like for now in blockchain, it's really trying to understand before it gets big. Like I've been focusing more on like earlier stage things, or partnering with people that are doing earlier stage things, understanding what issue you're resolving and how big that TAM is, that total addressable market. Because if you can grow into it and you can solve that issue, and then as we were talking about before, if you have really good talent, that's always the biggest bet. What is the talent, who you're betting on? If you can believe in that execution strategy, those are to me how you can find the winners in the market.
Yeah, thank you. And we'll swing back to talk more about, creative opportunities and allocations and that type of thing. But as we wrap up this portion of the panel, I want to make sure we address secondaries a little more. Calvin, can you help us understand where secondaries fit into a portfolio and what's an acceptable discount level for secondary buys? I'm kind of combining a few things, but help us just understand how you view secondaries as, I don't know if it's called an asset class, but certainly a strategy and where it fits.
Good question. I think the intended use behind them is shifting quite dramatically. Historically, a lot of LPs would tell me, we looked at certain managers, more of an IRR play. They weren't looking to achieve a really large MOIC out of it, maybe 1.4, 1.5 times net, but it would be a pretty strong IRR. And they could use those early cash flows to fund perhaps more higher returning strategies on the primary side. And with COVID stalling a lot of those deals, a lot of secondary managers are going into what's called GP-led deals, something that's actually been around for a very long time, and it's just kind of been rebranded as GP-led. And I view that as a little bit of a departure from what secondaries thematically have been, into more of a direct investment strategy that has, a return profile a little bit more similar to a co-investment, longer duration, more concentrated. So in short, I think there's two buckets now. There's the so-called liquidity secondaries, where you allocate to groups where you're maybe going to be getting higher cash flows that are super diversified. And then there's more opportunistic, where the secondary managers are aiming for 1.8 to 2x plus returns. They're doing fewer deals that are much more concentrated. So the landscape is shifting quite dramatically. In terms of what's an appropriate discount level, I know a colleague of mine says he won't buy anything if it's priced higher than 80% of NAV. And it's kind of an arbitrary number, because you could pay 100% of NAV for an asset that's really conservatively valued, or you could pay 10% of NAV for something that's valued at 100 times revenue. So we try and get away from what the actual headline discount is with an asset and do more fundamental analysis to see what is something actually worth at the end of the day.
Yeah, thank you. And Brett, given that you have a range of ways of addressing lower middle market, including secondaries, where do you think secondaries fit into the portfolio? How do you respond to some of the things that Calvin said?
Yeah, I think first off, I fundamentally agree with Calvin's last point, which is around, it's not about the price, right? Let's think about clothes, right? This shirt's worth $500. It's now on sale for $300. That's a deal. Human psychology loves hearing that, but it's not value-based. So for example, I've been doing what you'd call secondaries for over 20 years now. In buy and selling them at Star Mountain, we've been doing them for 12 years. We've made huge returns off deals that we paid close to par on, and other deals that were at discounts. And within the lower middle market, I think all the positions we have bought, none of them have ever had either a broker, an intermediary, nor have they ever had a secondary valuation firm, or a third party, I should say, valuation firm. So when you peel back the onion and you look at things, you look at some things that are way overvalued, some that are way undervalued, and at least within the lower middle market, that dispersion of what is at least our view of a realistic and a good value is very different. That commentary may not be relevant in the larger markets where things are probably priced much more clearly. Although I would say, if you look at, again, I'm a big fan of data, Lincoln, the largest third-party valuation firm in the US that also values our assets, they recently produced reports into the average EBITDA adjustments are 40% on a company. So big or small, I think it really behooves you to be able to really look into and evaluate the assets and look for what that future opportunity is. And that price may be above par, below par. It's really about what you think those future cash flows are going to look like, in our opinion. And I think with the aging demographic in the lower middle market, you're going to see a lot more GP-led. You're going to see a lot more zombie funds and other one-off disparate assets. So we like the business. We don't do it at Star Mountain in huge volume, but we really like the business, and we think it's complementary to be able to have a strong direct investing capability to evaluate the assets. And we also think that the secondaries business is a great case study business to help train the direct team as well. So we view them quite complementary, because we all want more data, more information, should make us, hypothetically at least, better investors.
Yeah, that's interesting, especially the crossover between your teams you mentioned, because I have heard people say that it's a very different skill set to evaluate GP-leds, which is essentially, direct deals or maybe co-investments or what have you. But certainly your team has a lot of experience there. So anyway, this is all fascinating, and it leads a little bit into more of the direct deal discussion that we'll have now. And pardon me, Michael Burt is going to be joining us as we shift gears, and pulling him up as a speaker, and pause for our second featured presentation, which will add some interesting context. Michael Burt is the founder and managing partner of Promethean Investments. Michael has successfully raised and managed 3 funds. He has sat on the board of over 15 companies and currently sits on the board of 9. Michael played rugby for Scotland and has been a pioneer in building consumer-facing businesses, in particular location-based experiential entertainment concepts built in the UK and expanded into US markets. Working back and forth across the pond, but now residing in Virginia. So it just brings some interesting and very specific expertise, and a hard head, I imagine, from the rugby days. Michael is sharing thoughts on how managers are using structures other than secondaries to deliver transparent returns. He's going to talk about how Promethean uses structuring in Puttshack, a new business from the founders of Topgolf. And Puttshack is an offering which is part of Promethean's first close for their new fund. So with that, Michael, welcome. And you should be sharing your screen whenever you like. Feel free to share your thoughts.
Great, thanks, Kevin. That was a very generous introduction. And Eric, to your point, I'm an immigrant. I've been here 6 years, and I recently became an American. So there we go. I I've been in private equity for the last 20 plus years. Founded Promethean in 2005. We've always been a structured growth investor, and we tend to be relatively thematic. First fund was 2005 fund to 2013. That was 40% gross IRR. Second fund is a 2015 fund. That's currently at about a 20% IRR. We expect that to increase. We've returned all the capital in that fund. And the third fund, we very much looked at a theme of location-based entertainment, which I'm going to talk about today. At that point in time, pre-pandemic, these were businesses such as Topgolf. And the reason that we like them is, as a manager, we have a couple of unique USPs. Probably the largest is we're one of the few businesses that can take businesses from the UK to the US or from the US to the UK at a relatively early stage. And for the right businesses, that's really attractive because it massively expands the total addressable market and thus potential valuation if you can go out earlier to a large market and actually prove your case. So founders and management teams love that as a USP. And we're typically focusing on businesses that are kind of the 3 to 20 million EBITDA range and looking to really grow those businesses through our ownership. We like to have a strong element of control in our deals, but we don't insist on being majority investors. So I'd like to showcase PutShack, one of our growth investments, and highlight the value created by structured solutions as we move through the growth cycle. And I think a lot of these businesses, particularly the four-wall businesses where you're dealing with a venue, the best ones share similar characteristics, and that makes them ideal for a growth investment because you can put a small amount of capital in at an early stage on something that's performing well and effectively lock in a larger amount of capital effectively as you roll them out and have a relative...
Michael, I just wanted to mention, I don't believe you're sharing your screen. I'm not sure.
No, I'm not sharing. I'm not sharing yet, Kevin. I was...
okay, thank you.
I was really about to, so...
Take your time.
Yeah. So yeah, similar characteristics across those businesses, and that allows a relatively high degree of repeatability. Okay. So, you know, a lot of these businesses have highly repeatable characteristics, and that makes them ideal for a growth investment. And PutShack is certainly one of these. PutShack's a location-based entertainment business that operates in the space of mini golf, and we have 15 years of patents left in relation to auto scoring and technology-enabled mini golf. PutShack comes from the founders of Topgolf, which recently sold to Callaway for $2 billion, which I hope some of you are familiar with and hopefully have been customers at. And PutShack sits in that experience economy that's growing really fast. Why do we love PutShack? Well, the product is great. It's better than the Topgolf product. It has a management team that came out of Topgolf that the founders brought and we helped supplement. It's got incredible site level economics. So in the top right corner of the slide, you can see the site level economics. But typically, we're in for about 6 million of year one investment, and we're generating somewhere between 3 and 6 million of year one EBITDA. It's got incredibly broad demographics, so it appeals to almost everyone. And most importantly, with the management team, the product, and the demographic spread, we can repeat it over and over again. And so we hope we can have 55 locations by 2025 in the US. It's important to say each venue's opened and been profitable in month one. And we had some phenomenal trading during the pandemic when we were open, with the sites delivering 36% EBITDA margin when they were only, broadly speaking, 10% behind in terms of revenue, despite social distancing and all the other things we had to deal with. The game is relatively unique in PutShack. It contributes 50% of the revenue and is 95% of the margin, which gives us significant operational ability to drive higher EBITDA margins than you'd see in a typical restaurant hospitality business. And as a result, you know, having effectively put money in via a convertible, we brought a bunch of investment banks to see the business when we were 2 years in. And this is a slide that Oppenheimer gave to us in terms of their analysis of PutShack and where it sits versus its peers. And what we have is something that we have the ability to drive incredible growth from, And also we're delivering incredible EBITDA margins. And, although we'd love all of our portfolio to sit in the top right corner of the screen, it's not always quite as clear as it is with Putshak. So some nice third-party verification there. So we've got this incredible concept. And then the next real kind of question is, how do we drive that to a valuable exit for ourselves, the founders and the management team? So Oppenheimer were kind enough to give us this football field of valuations, and JP Morgan and Citi came along as well, and they were broadly in the same ballpark. But what you'll see here is dependent on timing and growth. And this was done in February. So obviously public markets are down a bit since then. But if we can continue to deliver on the current run rates, we should be able to hit that 409 million of revenue that Oppenheimer have targeted, and potentially get the business out sometime in 2024 at this 1.5 to 2 billion value. And that would be on the back of around 100 million of current site level EBITDA, but growing dramatically as we push through that. So it's based on fundamental, it's not based on a silly multiple of EBITDA or revenue. And what makes us able to drive that level of growth within the business? Well, what we're doing now is we're putting a structured solution in place to allow the business to raise 150 million of debt. And we're effectively backing it with a fund guarantee or a fund commitment to invest in the business. And our first close investors are getting a warrant package, and the banks are getting effectively a guarantee that should the business slow down in terms of performance, we will come in with a committed investment bridge to take them out. So it gives us access to cheap capital to help drive the EBITDA. And what you'll see here is we're run rating at the moment to about 20 million of site level EBITDA. And as we build through this year, that will effectively drive up in the next 12 months to, broadly speaking, 50 million of site level EBITDA. And what we want to do is we want to pull forward a debt facility to allow us to continue to drive that EBITDA where there is a lag. But at no time should the debt facility be greater than really 1.5 times EBITDA to debt. And the guarantee that we'll have, and we've got 100 million, or just under of guarantees to date from our investors, is relatively low until, in terms of a multiple of both EBITDA and debt, until we get to a relatively mature space in the rollout. And so we believe that this should allow our LPs to get 100% return on their committed investment without actually ever being drawn. It allows the founders of the business to access a far greater exit value. And at any point in time, if the business's site level economics dramatically change, we'll stop the draw on the debt and the committed investment will come into the company at a market valuation at that point in time. And so, we believe this structure works very well, and we've used it on other investments in the four-wall space to effectively supercharge the value of the investment without putting our LPs under advanced cash drawing. So it works for both the founders and the management team who have significant ordinary equity. It works for us, and hopefully it will work for the bank group as well. And so we're out in the market with this opportunity at the moment. And I think it's quite a nice structure to, as an alternative to an early exit within the business. So very happy to answer any questions. I know it's slightly strange to see a tech-enabled mini golf concept raising 100 million, but when you set aside your view on the space, the fundamental data behind this business is incredible. We had, broadly speaking, 1 million rounds of mini golf played within the first 18 months. And what's really driving that is the fundamental product, and the numbers flow behind that. Interestingly, the Topgolf management team led the Topgolf business from 2007 to 2013 and drove a valuation of 30 million to 1.5 billion during that time. And at a site level, they improved sales 300% from 2008 to 2012, which was obviously over the course of the last recession on a site-by-site basis, not on a group basis as a whole. So pretty impressive management team, interesting business, and I think we've come up with a good structure for them to drive the business forward. So happy to answer any questions.
Yes, no, thank you for that, Michael. And I think this ties well into the conversation we were having before around the opportunities in the lower mid-market as you grow those businesses by being close to the management and the sector expertise that's involved, and being able to take this up to a more mature business where it benefits from the multiple expansion and so on and so forth. But how important, I guess I'll start with you, Sasha. How important do you feel sector expertise is versus the financial engineering aspect of what Michael's talking about in this deal in generating returns? And how do you view that element?
No, I think it's very important to actually really understand. Like, so when we invest, we definitely want to invest with partners that understand the industry, because it's really, you can't know everything. And sometimes understanding the details of something specific can be the difference between having something that's successful and not. So I think that there are just certain fields where you can't be a generalist, and it's important to understand, really understand the industry. So I would never try to invest in something alone where I didn't have the expert. But if when investing, as I was saying before, investing with a team that knows what they're doing, that has experience, that has a history of execution, are key things that we look for, because you're hoping that experience will help them navigate when things don't go right. And I think that it's when things go, and you're going to see that a lot now, right? For the past, forever, right? Everything's just been going up, right? And so now I think that you begin to understand who your partners are when things are going bad, and going through experiences that aren't just constantly up. And so it's important to have partners that I think that do understand what they're doing and have that expertise.
Yeah, thank you. And Eric, I'm curious. I know that this is nothing that's in your wheelhouse, but I'm wondering, you hear the types of returns that Michael's talking about on his prior efforts, and then I don't even know what the projected returns are on something like this. Given the denominator effect, you might not be drawn down at all. When does something like this become interesting enough, and maybe not specifically for you, but in your type of scenario where you need to mobilize an army of consultants and board members to evaluate something like this? How does that thinking go for you?
Being a public pension fund, we're so transparent. Our meetings are public meetings. They tape, everybody can watch. And when you get to sometimes too complex for the board to understand, or a consultant, it could be more challenging to move forward into a strategy, especially because, there are, if you don't understand it and down the road, it doesn't pan out, what are the risk exposures? Ideally, everything works out well, but we know that's not necessarily the case. Having managers that know the industry, that are focused on what they're doing is, probably more palatable. And when you're exiting stuff, is it a sale, or are you doing a convertible structure, and different strategies can be, add complexity, which can result in, some of us, the board members, not necessarily understand what's going on. So,
and I think that's a really interesting point. I mean, we're sort of one of the market leaders in the location-based entertainment space. And we decided that because the market was so high growth, there was an opportunity to put more structured investments in. We invested in this prior to COVID, and we've seen a 2.8 uplift in our investment based on the last round, which happened in September of last year. The rationale for using a convertible was that you never quite know what's going to happen. And clearly COVID happened. So I think we yeah, in the words of Gary Player, to use a golf analogy, the more we practice, the luckier we get. I think having a structured solution in place is always useful with these high growth or high potential growth businesses.
Yeah, thank you. And Calvin, pardon, this is not your ball of wax either necessarily, but you've been in the position of allocating and building portfolios. How do you view these types of opportunities that might be a little esoteric and creative in portfolio construction?
I think that they're great. You know, we do look to allocate opportunistically to managers like Michael. We look for, you know, a deep track record of doing these specific types of deals. It would be hard for us to gain comfort with a more generalist manager that is engaging in, you know, more niche assets opportunistically versus going into someone who's more of a sector expert. So we're always on the lookout for new additions to our portfolio where someone really understands a specific sector and asset class.
Sure. And Brett, I'm curious about your reactions overall, you know, speaking a little bit to what Calvin mentioned as well. You know, how do you evaluate these types of opportunities? I know you have a growing fund of funds practice as well. So how do you view these types of opportunities?
Yeah, from a secondaries perspective, which we have, we don't really have a fund of funds so much, but we do have a secondaries business, which is, you know, originating, evaluating, and managing lower middle market assets. That's where our core competency is. And then there are a number of sectors that we don't have strong competencies in, such as real estate, crypto, startups, things like that. So we just don't do it. Doesn't mean they're not good investments, but I kind of, whether I was not smart enough or not lucky enough, but I dabbled in venture stuff in the early 90s and that never did great for me. So I said, you know, I'm just not going to bother dabbling anymore. I'm just going to stay focused on what we do and what we like. And so I think that as I've observed, you know, the last couple decades of the alternative space and different managers, and the secondaries gives you a nice lens into what really is and isn't working, because everybody talks about these big wins, says how great they're doing. And then you look at secondaries like, oh, that's interesting. Maybe that's actually not so great. I think you need to have a strong core competency and be good at what you're doing, period. And there are lots of opportunities. You know, Michael has a competency that way, and Calvin, his group, and what they're doing. And I think that from my perspective, you know, at least within the lower middle market, that's where you can have an information advantage. And unlike the public markets, there's nothing illegal about that. You can have a massive capability advantage. Again, unlike other markets, there's nothing wrong with that. And so that's what we like, is trying to exploit inefficiencies. And I like Michael's structural point where you're trying to protect downside, but also if things go really well, get some upside. That's kind of the way I view life. I think if you can not lose money, that's step one. Everything just tends to go a lot better. And then if you can capture some upside and get really creative in how you structure it, we internally talk about not getting creative with risk, but getting creative with how we structure deals and how we can try to create some advantaged upside so that if things do go well, you can participate in that. And from a portfolio construction, I think that's helpful because idiosyncratic risks and losses can occur. It's nice if you do have some things that might give you some incremental return within a portfolio, even just to get your baseline ideal returns.
Yeah, no, I agree. It's not about getting creative with risk. And the speakers certainly here are familiar enough where this might not seem so esoteric. So I didn't mean to raise a flag there, only that, you know, because we have a range of institutional and in some cases, high net worth investors in the audience and so on. You know, if they don't understand something, they might find it to be esoteric or perhaps carrying more risk, but the convertible structure, I think, avoids a lot of that. And it's more about finding greater returns in the lower mid-market, the way that we talked about, while managing the safety and the risk aspects. So with that,
And if I can, I'll give you one quick little fun thing. This will tie to Michael's golf analogy. So my average golf swing, right? When you think about people saying, well, it's on the fairway, you think, well, that's what you usually do. Mine, unfortunately, on average, is not in the fairway. It's in the rough, which is maybe why I don't golf so much, or maybe it's because I don't golf so much. But the point is that if you think back to 2007, people say, oh, that's down the fairway. And they view it because that's what everybody is doing, right? And when I looked at things in that market and silliness that was going on, I said, just because everybody's doing it doesn't mean it's right. But human psychology, people feel safe with that. Piling into the markets, piling out of the markets, going into things that seem, well, that's kind of the plain vanilla, or that's down the fairway. And it's not data driven. Whether you listen to people like, Warren Buffett shareholder meeting going on, and you listen to people like that has been one of the most successful investors of all time, or you just look at basic data and you look at what happened to Lehman Brothers, Bear Stearns, AIG, and by the way, had the Fed not bailed out Goldman Sachs and other, I shouldn't say bail out, but allowed them to restructure and support them, right? A lot of other phenomenal institutions with great people could have perhaps went bankrupt as well. And that, people viewed that stuff as down the fairway. I think in markets that are toppy like this, you get a lot of things that people use the golf analogy, but it's wrong, right? Just because everybody's doing it, it just means you got a bunch of bad golfers like me, and just because everyone's doing it, it's still in the sand and in the rough. It's not actually, in fact, on the fairway. So I would caution people to really focus on data and fundamentals. And if you don't understand it, probably just don't do it. Find things that you can get your arms around and you can understand.
Well, that's where the sector expertise that I was mentioning comes into play. And I agree with you that, yeah, I want to circle back to Michael and you bring back a question that I put to the team in the past panel around private markets lagging public markets, but certainly it's a signal. And you can feel the sentiment out there that we've had recent corrections. There are perceived headwinds, as Brett says, toppy markets, and you don't get paid to do what everybody else does and just hit it straight down the fairway, but you can find a shortcut in some cases. So, Michael, how are you going to handle potential downturns, and how have you handled these types of things in previous market swings?
Yeah, I mean, I think we always look at structured solutions. So we're very rarely pure equity. And we've been through 3 significant issues over the course of my fund's existence, or my fund's existence. So the first was obviously the financial crisis. Interestingly, the second didn't affect the US at all. It was Brexit, which was obviously a big deal in the UK. And then the third has been the pandemic. And, you don't buy insurance because you expect your house to go on fire. You buy insurance because, the cost of your house going on fire is life-changing. And that's the way we look at structuring. So we put the work in to structure our investments. And, we've had situations where, we've had, founders, we've had management teams, we've had vendors rushing us to close transactions early. We've had lawyers who've had, mental fatigue because of the structures we forced into transactions. And the cost typically isn't a valuation cost. It's typically a time and efficiency cost. And so we're always looking to put structures in place that minimize the downside risk. And we had a very successful buy and build in our first fund in Cambria Automotives, which was in the motor retail space. And we started that business in 2008, and we bought underperforming motor retail businesses, consumer-facing industries, and that's really our area of expertise. And we were not paying high asset values for those businesses because they were underperforming. We were buying at a discount to net asset value. So even if we couldn't turn them around, we could liquidate them and make money. And that strategy worked pretty well until 2008, and it worked really well after 2008 because we had that cushion in the business. and we had plenty of targets. And I think it's about backing best-in-class management teams in businesses where there is clear data, coming to Brett's point about the ability to grow. And if you can take a sophisticated approach to analyzing the businesses you're investing in, and you have good data around them, and you have clear routes to market, in the lower middle market, there's always an opportunity to win. So you can always grow the business, because fundamentally, none of the businesses you're going to be in are going to be significant market share participants in their total addressable market. So, if you're backing best-in-class teams with really good businesses, and you've got structured downside, so everybody else is kind of behind you in terms of the cash, then you've got great alignment and you just drive from there. And that worked very well on the back of Brexit when everyone was running for the hills. In our second fund, we bought a business called Brickability. It was the largest supplier of bricks in the UK. We bought it at 3.7 times EBITDA, a business that had been around 35 years and was growing fast. And the reason we were able to do that was, the market took a view that in a time of crisis, nobody was going to be buying bricks and building houses in the UK. And, fundamentally, the market readjusted. We grew the business 4 times in terms of turnover, because one of the things that seems to have happened out of Brexit and the pandemic is more housing. So we were able to grow volumes 4 times, and we were able to list that business at a 7 to 8 times multiple, and we made 5 times our money in 4 years. But we went into that business with a structured solution, a convertible at a low multiple, and drove it from there. So I think it's just those good private equity disciplines that Brett highlighted very nicely in his presentation.
Well, I'm glad you had an opportunity to share that. And I want to point out that we're unfortunately running out of time. I may have started you a little late there, Michael. And just as a speed round, going through everyone on a couple of questions, I just wanted to touch on, since we delved into the potential for a downturn, what's the biggest concern for each of you going forward? I suppose I'll come back to the top and start with Sasha. Biggest concern going forward at the macro level and within your portfolio?
Well, on the macro level, I think that, I can go on this, but really just the cloud of all our growing deficit, where are the entitlements going? That continues to grow. And because of that, can the US really manage interest rates appropriately to bring down inflation? I think we are kind of in a pickle. I think historically, the idea was we can keep interest rates low and that inflation would stay manageable. And that's the opposite of what's happening. And have we let it gone too far? And can we do anything because of where the deficit is? And I think that's really my biggest fear going forwards. And I think that that's also going to put pressure. You're not seeing it now, but on the US dollar, right? And I think that you're seeing a lot of countries adopt alternatives or trying to push alternatives. And so I think that from that, it makes me nervous on the macro level. And then from a micro perspective, that affects, our portfolio, right? Like you saw it in earnings, where expenses have increased significantly, are now beginning to cut into profit. And what does that do with valuations, right? Typically, when we invest, we try to figure out, can things grow into the valuation, as we talked about, like with hopefully TAMs that are that make sense. So I think right now it's just important to really stick to things that we think are resolving an issue, as I was saying before, that are disrupting things where it can grow into the market, because it's really hard to put your arms around where valuations are going to happen. And then really where rates will go, right? We've done a lot of sort of like private lending. We have we've partnered with people that do a lot of private lending. But if rates continue going up, those rates in real terms and with inflation don't really mean anything, which also goes back to tying again to valuations, right? Was your loan to value might have been, you might have thought you were at a 75% loan to value, but now in this market, you're really at a 90%, right? Like, can that 90% become 100%? Are you equity now? So things like that, the way it's accelerating are things that, keep me up at night. Thank you, Kevin, for having me.
No, thank you very much. And Eric, what are your biggest concerns?
I'd say a combination. It's obviously the interest rate increases is going to slow down the economies domestically, as well as some of the other domestic developed markets, as well as the geopolitical situation. You have in Europe where they relied on Russia for energy, and now as they no longer, they're going to now have to look for other sources of affordable energy sources, and then the whole realignment of Russia and new partners. They're going to go with China. They're going to go with India. There's going to be like a new lines of who's friends and who's not, and versus having everybody working more together as in the past, where everybody prospers and keeping things stable. Then if Russia obviously continues to expand and expand into other countries, we're going to be drawn into a much longer and difficult decisions at the higher levels of government, getting it more involved to prevent stuff. So I think that's going to be a challenge. And if the economy slows down, it's going to, it's going to not be good domestically, because people will lose savings, lose wealth. From a pension plan perspective, last year was a very good year to close our unfunded gap for many public pension plans. And as things go down again, we're going back to that issue of, okay, we got to revisit, how we're going to close that gap again. And it takes time. You have many factors and decisions to close that.
Yeah, thank you. And Brett, what's your concern?
So one of them, I'll dovetail quickly off of Eric's view around geopolitical. I think that is good to remember that just because this issue is going on right now in Ukraine, it doesn't make other issues less likely. I would think it amplifies it, because they view that the US can only help fight so many other wars at the same time and so forth. So I think in my view, not a geopolitical expert for sake of clarity, but I do view a heightened risk just from basic logic. And we do have investors from nearly 35 countries around the world. So I often tap into that as I do my YPO network globally, just to try to learn from people as much as I can. And there's a lot of concerns there. And so to me, what do you do about it? Not a safe haven per se, but I like the US best on a relative value basis, because I think it's less impacted and more resilient and sustainable as an economy, relative to Europe and other certainly developed markets. From a rising rate increase, a little bit more specifically, where I'm concerned is in the amount of debt that has been invested in middle and large market companies. Many of them have very low fixed charge coverage ratios. So that means that they barely have enough cash flows to service their current interest rates. How much higher rates can they afford to pay? So that's a cost increase. And then supply chain risks, how much cost increase of labor, cost increase of delayed, goods to be able to sell them. I put an order in for Tesla last May, was supposed to come in December. I'm still waiting for it. That's the same thing, moved into a new house. There's lots of things that we've been waiting for a year and a half, 2 years, and we haven't paid for most of them. Like Tesla, I think it was $100 down or something like this. And this isn't to say Tesla is or isn't a good investment for sake of clarity. It just is a good example of supply chain issues. Even if the demand is there, can you actually make it to sell it? So I think that is a big concern for us. And what we're doing about it, which I always love, is the dovetail, is stress testing all of our portfolio to see what is an extra 200 basis point cost increase due to all of our companies, which ones of them may have more fragility than others. So you can start to preemptively try to get in front of risks and develop, your B and C plans.
Right. Well, thank you for that. And since I've already clearly broken my rule the first time of going over, I'm just going to continue this track for those still with us. And Michael, what's your biggest concern moving forward?
I mean, look, I think my biggest concern is really the impact of inflation and potential interest rate rises on consumer demand in the domestic US. Because that's our big focus. So, we're looking at all of our portfolio businesses and working out how we can really, drive the experience to keep the demand there from a numbers perspective in the event that there's a downturn in consumer spending. So we're looking at cost reviews within all of our businesses preemptively, which is interesting when you've got businesses that are growing fast. So we're looking at kind of site and venue level cost reduction pretty aggressively in both the US and the UK. And then I think when we're looking for new opportunities, we're looking for portfolio companies that are going to be best in class and where demand relative to other products in their category isn't going to be hit as much. We're probably focusing towards smaller ticket items rather than big ticket, because we think there's been a boost in big ticket items artificially during the pandemic. And we think there's going to be some excellent opportunity in disruptive tech, consumer facing businesses where, VC valuations have got a bit ahead of their skis, and VCs typically aren't very good at structured growth solutions. So we see some really exciting outcomes if there is a slowdown. And we're very focused on making sure our portfolio is ready for that in the event that it happens.
Well, as I started out this webinar talking about, it's a tricky environment. We all know that. And we've hit some of the depressing elements, but it strikes me that the managers here turn that around to say, well, here's where the opportunities are. And that's how you get paid. And that's why you're aligned with your investors. So with that, I want to leave you, Michael, with the ability to tell us, as much as I painted this esoteric picture around the things you're doing and creativity and things that, may not fit as well. We've got a potential downturn coming. How's it going in terms of fundraising and finding deal flow yourself?
I mean, look, I think we've got some really interesting opportunities. Look, I would just like to, if you'll bear with me, kind of all share a screen with you guys of Putt Shack. So this is kind of what our venues look like. I don't know whether you've got that. Is this sharing or not? So I hope that gives you some idea of the kind of stuff that's going on in our venues, and I think the kind of nice thing about a downturn is everybody still enjoys going out to have fun and have a drink. So hopefully we won't see any spread in the geopolitical instability that we've seen in the last few months, and there'll be more of the kind of Putt Shack, the downside in the future, but we'll see.
Well, here, appreciate the optimism. Kelvin, I skipped you before. How are things going on the fundraising and seeking deal flow aspects?
Oh, certainly it's going well. Lots of interesting deals in the market. I guess just to finish off in the same light as the others on the panel, I guess concern would be over just simply the leverage levels out in the market, certainly on the secondary side. if you have a $5 or $10 billion fund, it's a race to, investing in these large scale auctions to buy LP stakes. And unless you're paying 95 to par to 105% of NAV, don't bother showing up. And you got to make leverage a huge component of your strategy. So it's a big concern there. And then I'm hopeful, as also an allocator on the fund to fund side, that other LPs in the market use the Russia-Ukraine ordeal to actively look into their manager relationships and see, who else is there that isn't ESG compliant, and really try and stress test that.
Yeah, thank you for that. And Sasha, how are things going in terms of allocating and finding the opportunities in dealing with this market?
I think like everyone here said, there's a ton of deal flow, a ton of managers. The biggest issue is trying to find the ones that make sense, right? You really have to go through it and try to understand like what's the real value add, what are they doing that's differentiated, and really the experience and the ability to execute. As I was mentioning earlier, we've just been in an environment where everything's inflated, everything's been going up. And at least finally now we're beginning to see some adjustments, some normalizations. And so really, trying to, I'm sure like everyone here sees, for instance, 100 multifamily value add deals where, it's the same story, right? You can, whether it's Texas or Florida, you're buying an apartment and you're fixing it up. And how many of these do we see, right? What's the real value there? All that's been really, as I think you mentioned earlier, Kevin, is financial engineering. And now I think we're in an environment where you're going to see where people really need to have like a real skill set where they're adding value and doing things that it's not just about financial engineering in the market, what the Fed's doing. It's really trying to do things that make sense, whether it's restructuring a company, growing a company, whether it's in real estate, where it's not just where you have to, the cap rates make more sense, for instance. So now I think we're just in an environment where it requires a little bit more work and more due diligence, and really understanding history and track record is more important.
Yes, thank you. And Eric, how are you navigating the environment, making allocations?
We're just keeping our course, work with consultants, and try and keep our, we have a strategy of keep it well balanced, our portfolio, so we're not overweight in one area or underweight in the other. And as things shift, we'll rotate, but we stick with what our traditional investment policy range is, and we're just continue looking at different options and new strategies that are out there.
But are you skewing more towards private markets and what I was eschewing as the benefits of insiders with sector expertise and that type of thing? Or is it perhaps even going back into your hole and being more cautious with?
No, I think going private markets is the growth area. You don't have the volatility that you're going to be experiencing on the public equities, public debt side of the portfolio. Valuations, the companies are growing, and there's going to be buyers out there for whether you're a strategic, eventually you're going to sell it to a strategic or take it through an exit. So there's going to be greater return over time in the private sector, in the private market. And then the valuation, there's more complexity, allows for more yield at different times, and whether you're going into a private credit structure where you're able to have more covenants, and then with the companies adds value. As companies shift, as the economy shifts, we continue to see companies are going to grow no matter what. Not every company is impacted by a downturn. Some will do very well. Many times the companies that are private have more leeway. They don't have to cater to the public markets of meeting their earnings expectations. If they run into a hiccup, the only people I know are the investors and the management team, and they have more leeway. So I think there's more opportunities and strategic wise to handle a downturn in the market if you are a private company.
Well, thank you for that. And going out as we came in, Brett, thanks for your patience. Take us out. How are you navigating this environment, fundraising, deal flow, so on?
I think given I commented a little bit at the beginning of this, I'll maybe just add on to, which is always an easy thing to do. I'll add on to what Eric said, and look, I view from a probability weighted perspective, it's a lot easier to get paid for patience and illiquidity. And if you look at data on people that try to time markets and bet on stocks, probability is wildly against you. And there's lots of data available, around that. And so I think to Eric's point, for my personal portfolio, my home, cash, 100% of the rest of it's in our funds, which is all in private assets. And when I started the business, so 20 years ago, I probably had to do that. Today, I choose to do that. And once again, just because I think it's easier to get paid for illiquidity than it is to try to time the markets. And I'll give one last little plug to Buffett. He gives an analogy and said, would you pay a 2 times higher price for your house if it had a daily mark to market on it? And people say, no, that's absurd. Why would I do that? I'm not needing to sell my house every day. I'm not going to pay double just so every day somebody can give me a value on it. He says, well, why are you doing that in a lot of public markets? So I'll end with that as some food for thought.
I knew there was a reason I closed with you, Brett. Thank you very much. And really, thank you to all of our speakers, Eric, Sasha, Calvin, and Michael, of course. Thank you for that presentation, bringing us through our second half. And thank you for all of you on the box joining us. And our next event will actually be a live in-person summit on September 7th in New York City. Star Mountain, along with other familiar LP and GP speakers, will be joining us, and insider guests will be able to join us at a landmark property to be announced shortly. Unfortunately, space is limited, so register to apply for a slot and join our sincere efforts to build and strengthen key relationships via interactive panels, targeted meetings, cocktails, networking, dinner, and world-class entertainment. Not something you want to miss. Unfortunately, we can't bring
Michael's mini golf.
I wish, but not yet in New York, unfortunately, Brad.
Soon, we hope soon.
We may need to make special accommodations. I don't know, but keep an eye out for the registration for the link on September 7th in New York. And as I follow up with recording links and other notes, you'll see that. And as a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content and our community. This is really what makes it work. So thank you for joining us, and feel free to reach out and chat about what you're seeing, what you'd like to be seeing, and I may follow up with you to chat about deals and funds that fit your interests. And meanwhile, I sincerely wish you the best. So goodbye, everyone.